Tim Urbanowicz, head of research and investment strategy, Innovator ETFs, joins us now. So, Tim, tech has been really the driver this week. We're seeing some cooling today. Nvidia, not there though. It's still gaining some ground. Take us through kind of your assessment of where Nvidia is in the support in the tech sector.
Yeah, well, it's unbelievable, Diane, and clearly this was not just an important week for NVIDIA, but the market as a whole, to show that there's still a lot of wind in these AI sales. I view NVIDIA as almost Patrick Mahomes in the fourth quarter. You just cannot bet against this stock. It just continues to impress over and over again. I do think that we are having a lot of conversations with advisors right now about how to maintain the exposure. They are getting a little bit nervous as this stock continues to tick higher and higher. You look at some of the projections for what margins are going to be over the next 5 years, 60 to 70%. That's a little bit concerning. Can they do it? They've proven it over and over they can, but it's still going to be a high bogey to hit. So that's really the key right now, is not just NVIDIA, but tech as a whole. How do we get the exposure? How do we maintain the exposure, even get more of it, but make sure that we're managing that downside risk?
Okay, so I like that when you talk about managing the downside risk, and also I love your analogy when comparing it to Patrick Mahomes, because yeah, that was a tight game, but clearly you couldn't bet against Patrick Mahomes. Yeah. And I've heard analysts talk about this with NVIDIA, depending on who you're talking to. Jensen Wang would probably say you got it correct. But let's talk about just how much more can this stock run? How much more runway does it have?
Well, I'm running out of ideas to see where it can surprise to the upside. And I think overall, Dan, is investors really need to just temper their expectations moving forward. We're coming off a year last year where they were up 239%. You're up another 50%, just about 50% this year. That pace of growth is unsustainable. So we just need to really tamper it down, put that in perspective. If we were to see another year of growth like we saw last year, you would put NVIDIA's market cap higher than that of Microsoft. Meanwhile, they had about 13% of the revenue that Microsoft generated last year. Not to say that they can't get there, but we need to focus on how long it's going to take to get there and really slow up the expectations for future gains.
All right, and so let's talk about managing potential downside risk. You have a QFLR ETF. It's the Innovator NASDAQ 100 Managed Floor ETF. If I'm getting that incorrect, correct me. Yeah. So talk to me about this ETF and how that will help manage downside risk and help with potential exposure in this sector.
Yeah, so Dan, really very simply what this strategy is designed to do is to provide that tech exposure. So you have exposure to the NASDAQ 100 with a built-in managed floor against losses. So we're targeting a floor of 10% in the strategy. We use a short-dated call selling strategy to really help offset the cost of that protection and make sure that we're getting the maximal upside possible in the strategy. And right now, when we're talking to advisors, one of the biggest challenges that they're facing is they have their clients that are either in retirement or very near retirement. They're seeing the big gains in stocks like NVIDIA this week, and they're saying, I need more exposure there. I need more tech. Why do I not have more tech in my portfolio? And as an advisor, it puts you in a tough spot because they know that the NASDAQ as a whole is very volatile. It's an index that has seen drawdowns of over 80%. Even a stock like NVIDIA has seen multiple drawdowns of 80%, a 40% drawdown back in 2018. So the struggle really becomes, how do we give them that exposure without putting ourselves on or give us the possibility to really derail their financial plan? And I think that's really where the value of a strategy like QFLR comes in, is you're able to provide that, but you're also able to keep those financial plans on track by hedging the large drawdowns. You're really protecting 90% of investor capital with the strategy.
All right, another stock you've mentioned, and I see in your notes, that looks like it's a bargain. Talk to us about Alphabet Google. What's the thesis behind this potentially being a value proposition here?
Well, it's trading at one of the cheapest levels we've seen in recent history. I think there is a little bit of concern about, are they going to continue to be the leaders in search? They have a proven track record here. They have a lot of cash to spend to make sure that they're out in front. I think that those concerns are overblown. So we do see a stock like Google as a potential good buy here, just given where the valuations are and where it's been recently. But again, even here, we think it's really intention. How you are getting that exposure really matters. Strategies like QFLR, again, very good way to do that. Get exposure to the Mag 7, get exposure to tech, but do so in a manner where we're really in control of those downside risks.
Are you worried about any red flags, potential for, are we still really just in the early days of AI, particularly generative AI, or is there a bubble on the horizon?
Yeah, it's an interesting question. I think it's very safe to say we're not in a bubble right now. Again, if you look at valuations trading, Nasdaq about 30 times, just under 30 times forward earnings. We were trading at 100 times forward earnings back in the tech bubble. So right now we're not there. But just with how quick we're seeing some of these stocks run up, like Nvidia, it does concern me that we could be heading in that direction. Bubbles are all about just the market getting way ahead of themselves. You think about the tech bubble back in the 90s, there was a lot of substance behind the internet, right? That was going to be a transformative technology. Just same thing with AI. It's going to be a transformative technology, but the bubble starts to form when investors start to extrapolate these cash flows way far out into the future. So if we continue to see the huge run-ups like we've seen here recently, I'll start to be a lot more cautious. But also, Diane, that's one of the reasons why you need exposure too. Everybody talks about the popping of the tech bubble just destroying portfolios, which it absolutely did. But let's not forget, from 1995 through through March of 2000, the Nasdaq 100 ran up over 1,100%. That's generational wealth that's being created there. And if you have exposure and you get out at the right time, it didn't really matter that the fundamentals didn't support it. Obviously, that's very hard to do, which is why we think having the exposure with built-in risk management, if we start to head into that bubble territory, very important on both ends of the coin.
Tim, bringing up the 90s for this conversation, a throwback there. I don't know if you were old enough to even be around for all of this. Tim Urbanowicz, head of research and investment strategy. All right. Innovator ETFs. Tim, have a great weekend.
You too.